Okay. Good morning and good afternoon, everyone. Thank you for joining us today for the second day of the Making Finance Work for Africa 2020 Annual General Assembly. This is the first session of the day, and it is my great pleasure to be the moderator of this session. I'm Olivier Vidal. Next slide, please. So today, the next hour, we'll be discussing the challenge and opportunities thank you. This session is about challenge and opportunities to mobilizing investors' assets in the COVID-19 institutional context. And we have the great pleasure today to have with us three experts. We have the pleasure to have with us Nzomo Mutuku, who is the chair of the African Pension Supervisor Forum and CEO of the Kenya Retirement Benefit Authority. Jacqueline Irving, senior economist at the International Finance Corporation, and David Uduano, the CEO of Sigma Pension Limited in Nigeria. I will, next slide, please. We have just 1 hour, so what we will do today is to start by, I will give a brief overview, introduction to the topic and the context, giving some information about the pension fund industry and how they invest, what we see as the investment in different asset classes in the continent. We'll talk about a project that Making Finance Work for Africa has been working on with IFC over the past year to look at how institutional investors allocate their asset and management and what are the challenges and opportunities they face from a regulatory perspective. And after that, we'll have a panel discussion for around 30 minutes, and then hopefully some time for Q&A. Feel free to write any question you have on the chat section during the presentation and the discussion, and then I will read them to the panelists at the end during the Q&A. So, as I mentioned, our objective today is to look at how African institutional investors allocate their assets under management, discuss the challenge and opportunities to deepen their participation in the market, and discuss the role they can play to support the post-COVID-19 economic recovery. Next slide, please. Next slide. Next. So, as I mentioned, African pension funds, briefly, both public and private, have been expanding in several countries, offering a viable option for long-term financing opportunities. However, this growth has not necessarily translated into increased investments in the real economy due to broken links between long-term financing, supply, and demand. Next. Here, of course, what you see is something that we see in most African markets. There is some level of, there seems to be some level of diversification, but there is an overrepresentation of investment into government papers and government securities from the pension fund industry. The example of Nigeria is applicable to most African markets, and this is something that when I will tell you about the project we are working on, that we see in most markets. Next slide, please. So, as part of this analysis, we analyze pension fund investment and regulation in 8 markets, and we can see, for instance, here that looking at the 3 key markets, okay, Kenya, Nigeria, and South Africa, the biggest markets in Africa, that alternative asset classes, so including private equity and REITs, represent not only a small share of asset under management, but are also, as you can see in this graph, well under regulatory ceilings. Next slide, please. Similarly, investment in listed equities and corporate bonds in 5 of the markets we analyzed are not only relatively small in terms of percentage of asset under management compared to pension fund investment in other regions of the world, but are also well below their national regulatory ceilings. Next slide, please. So here, we try to summarize basically what we see for now as the challenge and opportunities to deepen pension fund participation in the market and policy options. So there's a need for policy dialogue. The question of de-risking is very important. The question of capacity building. So of course, depending on the market, the size of the capital market and how it is developed, the debt equity also, all this, I can say this entire spectrum of challenge and opportunities that needs to be looked at from a development perspective, a regulatory perspective for the regulator, the policymaker, if we want to really support the pension fund industry to deepen. Next slide, please. So as I mentioned in my introduction, Making Finance for Africa has been working with the AFDB and IFC on a joint publication for over a year, looking at how pension fund or the pension fund sector in Africa has been investing in the past, looking at the past 5 years horizon. Next slide, please. And the objective of this study is to understand how institutional investors in Africa currently allocate asset under management and their actual and perceived impediment for further diversifying their portfolios. And in the first phase of the analysis, we started by analyzing pension fund investment and regulation in 8 African markets over a 5-year period, using data and information publicly available from national industry associations, supervisory authorities, and other local data sources. And what we particularly want to do is to understand current and potential investor interest in asset classes and financial instruments that would provide medium to long-term finance for infrastructure and pool capital for investment in private equity and venture capital in strategic sectors. And the objective of this study, which we hope will be finalized in the next 3 to 4 months, is to be able to quickly understand the extent to which local institutional investors are taking a more diversified portfolio approach over time and to compare this between countries. And by doing that, we hope that development partners can also identify potential areas for market intervention and to support national policy and regulatory reforms. Next slide, please. So this is just the timeline of implementation of the project, and we hope to make this publication available between the first quarter and the second quarter of 2021. Next slide. Thank you. Next. So now we'll have the pleasure, today we have the pleasure to have with us Jacqueline Irving, David Uduano, and Zomo Mutuku. Jacqueline has been working with Making Finance and the FDB on this project for a long time, and she has extensive experience working in pension fund industry in Africa and elsewhere. David Uduano is the CEO of the Sme Pension Fund in Nigeria and former chair of the African Pension Fund Supervisor Forum. And Zomo Mutuku is the current chair of the African Pension Fund Supervisor Forum and CEO of the Kenyan Retirement Benefit Authority. Thank you so much for being here. I hope you can all hear me well. Without further ado, let me hand over to the panelists, and I will start by asking a question to David Uduano. And David, can you tell us a little bit in Nigeria what are the main challenges the pension industry is facing now with the COVID-19 crisis?
Thank you, Olivier. So before the crisis, we've had problems or challenges with how to channel the growing pension funds into the real sector and into capital markets. From a regulatory standpoint, the regulators have done quite a bit, and so the guidelines are there and the allocations are there. But the actual investment was way below the ceiling. I think that problem got compounded by the COVID-19 crisis because on the macro side, we started having challenges with the fiscal imbalance in the system. Government budgets were challenged. The major export earnings of the country dropped, which is oil, and therefore the government found it difficult to finance the budget and had to resort to borrowings from multilateral agencies, including AFDB, World Bank, and IMF. Secondly, there were challenges with the lockdown. Nigeria locked down for about 2 to 3 months, and in that period, people were not able to work, and aggregate demand dropped. Lastly, because of the drop in crude oil prices, there was a lot of stress on the foreign exchange markets, and the local currency, the Naira, lost, I think, 20% of its value within a period of those first 3 months. So all these things meant that it was a difficult investing environment, and the response of the central bank was to drop interest rate further and to use various measures to curb liquidity in the system, and that resulted in bond yields dropping from a high of 14% to currently as low as 6%. And the Treasury bill rate, which is the rate on short-term instruments issued by the central bank, dropped from 12% to now it is just about 1%. And so the challenge for the pension fund is that increasingly it is difficult to allocate the monies even to the default asset class, which is the government bonds, because the rates are very low and Treasury bill rates are low. The equity markets have done fairly well enough, but it's still not as deep. And what I've seen is increasing activities on the secondary market side, The pension funds allocation to equities have gone from 8% now to as high as 20% for some of the funds, and even some of them are now going up to 25%. So the problem is that in this kind of environment, it's difficult to put monies in the real sector. Private equity investment have struggled because of the devaluation of the currency. And we're still at the early stages of infrastructure investment. However, the government pension funds are working with the Sovereign Wealth Fund in Nigeria to set up a national infrastructure fund, which will be capitalized, I think, back to the tune of about $5 billion. The counterparty funding will be coming from the pension fund, the Sovereign Wealth Fund, and government will be contributing some of the assets. The assets are national assets like roads, toll roads, power assets, but they are largely transport infrastructure. And we think that this will be a big moment for the pension fund, working with government and the Sovereign Wealth Fund to put monies into the real economy. And it will be interesting to see how we can get support from the AFDB and other multilateral agencies, maybe as co-investors in some of those projects. So in summary, it's been a challenging period. The fund is not growing because the workforce, that used to contribute this money, a lot of them, people have lost their jobs and they're having to access the pension fund. But on the bright side, because the default asset class, which is government bond, have all but disappeared, the pension funds are now being forced to invest in infrastructure, in housing, and in real estate. And there are progress being made in this regard. Thank you.
Thank you very much, Nzomo. Very interesting. David, sorry. Nzomo, can I return the same question to you? Can you tell us a bit in Kenya what is the situation now, and what do you see the pension industry is facing, the main challenges they are facing now with the COVID-19 crisis?
Thank you very much, and thank you for having me on this important forum. From Kenya, similar to what David has talked about, 4 areas that have been impacted through the COVID pandemic. One, outright withdrawals from our pension system because companies have closed down and retrenched workers. And in our system, because we don't have preservation of benefits, like many African countries, it means that if you're retrenched, you can come and access most of your benefits from the pension scheme, not all, but most, maybe 3/4 or so. So those who are retrenched came and took their money out, and that's a direct exit from the system. And I know even in countries with preservation, some did allow, because this was a unique circumstance, they did allow some kind of partial access, so not just unique to us. Number 2, we did give some temporary relief on contributions to employers. We had a lot of employers who had stopped business, as David has said, maybe due to lockdown or whatever reason. We had hospitality industry, which was really affected. All the hotels were closed, airlines were not flying, restaurants and so on. So, I mean, they were not operating. So we allowed them to take holidays from making the contributions to the scheme, both employer and employee contributions. Those were between 6 months, 9 months, in some cases, as long as 1 year contribution holiday. So again, that was money which would have come in, which never came into the system because they were on those breaks. Number 3, just like in Nigeria, the investment side, of course, the capital markets, Nairobi Securities Exchange was really down. Real estate market was down. Rentals, some pension schemes have retail properties or commercial properties, and they could not get rent because the tenants had closed business or they are not operating and so on. So basically across the board, we saw depressed investment performance. I think the only bright light we saw was the gold, because we have a gold ETF in our securities exchange. But I think that has now changed. I think now gold is heading in the other direction. But at that time, it was really one of the areas of strong growth. And then, of course, the 4th impact was really on the compliance side. Pension schemes struggled with some of the compliance requirements, like submission of annual accounts. They were struggling to have the meetings, to sign the documents and so on. For us in Kenya, we require trustees to be elected. Some of them, remember, elected trustees. They could not have those meetings to do the elections and so on. So we gave some leeway. We had also just introduced a new guideline for compliance on governance, which was supposed to be complied with by the bigger schemes by June 2020, but they couldn't because they were having all these challenges. So we gave them some leeway, but I think now we have seen schemes are now able to adopt technology. We have seen schemes do annual general meetings online, like what we're doing today. So we have slowly seen those compliance issues being resolved. So I think now the big issue is those employers who had stopped contributions coming back into contributions, and of course the investment side, we're hoping to see the markets picking up. Yeah.
Thank you very much, Jackie. If I may turn over to you, you have, researched and looked at extensively the behavior of the market and the industry at the regional level. Can you tell us what do you see as short-term and more medium, long-term impact of the COVID-19 crisis on pension fund portfolio management approach? Anna Stefan, I believe there is also a slide for Jackie. If you can put it up, please.
Thank you, Olivier.
No.
In discussing short-term impact, just making one overarching distinction up front, the distinction between defined contribution and defined benefit schemes, of course. So generally speaking, defined contribution market players and members may tend to place more emphasis on growing their assets and generating investment returns over the short term than do defined benefit schemes. So perhaps we'll start with that as kind of setting the context overall. Defined benefit plans, of course, are meant to be structured to take more of a longer term view, and defined contribution schemes are less costly overall than defined benefit schemes. So for the region, broadly speaking, there has been a significant notable shift over the last 15 years from defined benefit to defined contribution schemes. Even 15 years ago, colleagues at the African Development Bank and I found that 12 of the 24 focus countries we looked at for the Africa Infrastructure Country Diagnostic had already begun making that switch. So of course, 15 years on, there's been even more progress. Defined contribution schemes are taking off and predominant in a number of countries. So to the short-term impact, because most African local pension funds, including privately managed funds operating defined contribution schemes, have tended to hold a relatively limited share of their portfolios in listed equities and other corporate securities. Dave, of course, gave a very good outline of the situation in Nigeria in terms of portfolio management in the midst of the crisis. They likely have been relatively shielded from the more immediate short-term crisis impact of downturns and volatility in capital markets. And of course, I'm speaking now based on the data and information we've been collecting in the African Development Bank, making finance work for Africa World Bank team. This at least partly reflects the lack of product, which with the equity markets remaining relatively small in terms of market capitalization and number of listings, even among the region's largest emerging pension sectors in Nigeria and Kenya, for example. So for Kenya, Dave gave the overview of asset allocation and initiatives for his market, notably the infrastructure fund. But just taking as an example, publicly available data for the entire industry in Nigeria, the second largest market pension industry based on assets under management in absolute terms after South Africa. The 5% of assets under management was in listed equities, and this remained relatively stable at just about 4% at end March, which of course was when capital markets globally had become very volatile due to the impact of the COVID crisis. So of course that reflects the limited amount that pension funds had been placing in listed equities. However, some pension sectors in the region, such as in Namibia and Botswana, with Namibia being the largest pension market relative to the size of the economy in sub-Saharan Africa after South Africa, were significantly more exposed to equities as an asset class when the crisis hit. Namibia held just over half of its assets under, the industry in Namibia held just over half of assets under management in equities. Botswana just under 2/3 as of the end of 2019. So we can assume going into the crisis that they had significant holdings in this asset class. So equity market volatility caused by the crisis from the short-term perspective likely had a significant impact on the value of these holdings. So ahead of the crisis onset, Namibia's regulator, NAMFISA, had reported pension fund assets growing by nearly 10% in 2019, largely driven by improved equity performance in the final quarter. And so this largely reflected Namibia's, the industry's large exposure, nearly half to the Johannesburg Securities Exchange All-Share Index, which increased particularly during the fourth quarter of 2019. And data released by the regulator this week indicates that the share of total assets under management allocated to equities fell from about 55% at the end of last year to around 48% at the end of March, when markets were so volatile, but had climbed back to 50% by mid-year. So on the longer term impact, the longer term nature of most of pension fund liabilities should of course confer longer term investment horizons where feasible and where markets can function properly, where there's adequate product. So this implies that losses in equity markets in the short term potentially could be recouped over the medium to long term as share prices recover. So according to anecdotal reports from credible market sources, where listed equity share prices have declined since the crisis, many pension funds are taking advantage now of the opportunity to selectively buy equities that have been issued by strong financially sound firms at the lower share prices. This, of course, was happening in particular in March, April, May. In this way, funds can seek to maximize returns for the contractual savers for the longer term as the market recovers, while simultaneously providing investment that would be needed to raise share prices. So at the end of last year, just ahead of the onset of the crisis hitting, even relatively well-developed pension sectors, such as in Nigeria, Mauritius, already had as much as nearly 1/3 and just under 1/4 of their assets under management in relatively liquid short-term assets. So in the short to medium term, pension funds in the region will likely experience losses, especially in real terms, due to the macroeconomic context of the crisis, right? The impact of monetary policy responses, the reduction in policy rates, and Dave has already outlined that for Nigeria, the drastic reduction in yields, both on short-term and long-term instruments due to the cuts in policy rates. So the lower interest rates, of course, reduce returns on these relatively liquid asset classes, such as bank deposits and short-term government securities. So there are signs already that this low yield context may be prompting at least some of the larger funds with adequate capacity to look more closely at so-called alternative asset classes, such as private equity, venture capital, which could provide a push to diversify portfolios, to take more of a longer term view. So that's sort of, in a paradoxical way, a good outcome from the impact of the crisis on macroeconomies and the pension industry. So an overall lack of alternative investment instruments across the vast majority of pension markets currently, however, means that in high economic growth periods as well, when interest rates are higher, African pension funds overall have tended to hold a relatively larger share of their assets in liquid short-term assets. where financial sectors are underdeveloped, it's not uncommon, even for investors with largely longer-term liabilities, such as pension funds, to hold a large portion of their portfolios in the relatively lower yielding assets. However, investors with longer-term liabilities ideally should not hold such a significant share in these low-yielding short-term assets from a risk-return standpoint, as we all know. So while cash and very liquid short-term instruments are considered relatively risk-free assets, they become relatively riskier in a longer-term portfolio sense because they must be rolled over at uncertain future interest rates. Where these short-term assets are in the form of government securities, they can potentially create a captive market for government debt securities issued at suboptimal short terms. So in the medium term and beyond, where pension schemes have diversified their portfolios, this could provide some protection from total losses on the investment side. Here, geographic diversification, as well as by asset class, particularly where asset classes and markets are not closely correlated in their movements. The risk of significant losses from holding foreign asset classes is considered relatively low, even in the short term, for most of the region's pension systems, where ceilings are set relatively low on the amount of assets under management held in foreign assets, and actually allocation falls well below the ceiling. So, sorry, if you could please turn to slide 3 on this one. We've already talked through this, a bit busy anyway. So as the crisis broke, the vast majority of assets held by the region's largest emerging pension systems were held locally based on asset allocation data at the end of last year. The largest emerging pension sectors in the region, excluding South Africa, Nigeria, and Kenya in absolute terms, as you can see, held only 1% of total assets in foreign domiciled asset classes. But Botswana and Namibia stand out in the chart as exceptions. At the end of 2019, nearly a third of Namibian funds assets were held outside Africa, a share that had dropped only 1 percentage point to 30% by mid-year of this year, and had remained relatively stable, relatively steady at the nadir of the impact on capital markets in March as well. So due to uncertainty, obviously due to the lockdowns and crisis impact, indicating that pension funds took a longer term view and not shifting allocations significantly geographically. Thank you.
Thank you very much, Jackie. Thank you very much. Very interesting and very informative. David, maybe I will come back to you and ask you what do you see in Nigeria, considering all this and the changes that are happening now. In which asset classes do you see pension fund play a more important role as an investor in the post-COVID-19, in the economic recovery?
Well, as Dave outlined, with yields having dropped so significantly, right, due to the cuts in policy rates, and there's also a policy that took effect coincidentally at the end of I believe it was right before the crisis hit in Nigeria, that has essentially banned local pension funds from investing in the open market operation short-term securities. This could very well give a prompt to the pension funds, which do have significant assets under management in that market, to take a new look at alternative asset classes such as private equity and venture capital. Now Dave is much better placed to speak about this than I am. It's his market. Yeah. But the data do show the beginnings of shifts, certainly out of short-term government securities in the last few, in the period since the crisis hit, certainly since the end of 2019, which is quite interesting.
Thank you. David, do you want to comment on it, perhaps? Can you hear us? I will maybe Nzomo. I wanted to ask you the same question in Kenya. Which asset classes do you see pension fund play a more important role as an investor in the short term?
I think the COVID crisis has shown us the value of diversification. You know, for example, Jacqueline has talked about the low take-up of offshore assets. We allow up to 15%, but as the chart shows, we are below 1% or just around 1%. Yet, in recent weeks, we have seen a lot of depreciation of the shilling, and actually the offshore portfolio has strengthened because of that. So those who are having the offshore assets are actually balancing from the shocks on the other side because the offshore is performing quite well in shilling terms. I think we are seeing pension schemes showing more interest in alternative asset classes. For the last 4 years or so, we have allowed private equity investments up to 10%. The take-up is also below 1%, but it has been growing. It has been growing quite fast. This is another area which is proving resilient because private equity tends to be invested in fast-growing areas of the economy, which perhaps are not so impacted or which are more resilient to some of the shocks. So that's another area that we are seeing a lot of more interest. Recently, we amended our guidelines to allow investment in infrastructure, another 10%. It's new, but we are seeing a lot of interest there. We have a consortium of schemes that have come together. And they are targeting to invest in infrastructure jointly. So we're very excited about that. So yes, I think COVID has brought alternatives more to the forefront, and we are seeing a lot more interest there. And I think it's a good thing because to give us a more diversified portfolio so that when future shocks come, we are able to handle them better.
Thank you very much. David Udouanou, can you hear me?
Yes.
Okay, so I wanted to ask you the same question.
Okay, so I think it's similar. The area of biggest interest in offshore investments, diversification outside Nigeria. However, we have no allocation for that. So the guideline currently prohibits that. I mean, that's, I think, would have been the biggest area of interest because that would diversify away the Nigerian currency specific risk. In the absence of that, the other areas are alternative investments. I think starting with housing, because housing has a double impact in the sense that our members are able to access funds to finance mortgages. And also, because these mortgages tend to be long-term, the interest rates, you suffer less reinvestment risk. I think Jacqueline made that point that for the short term is now becoming riskier because of reinvestment. So when you get the monies it matures, you are investing into a lower interest market. So we're looking for things like mortgage bonds that will be financed by pension funds that will be used to support mortgages for members. The other areas, of course, is private equity. I have to say that private equity have been challenging in Nigeria simply because the traditional private equity model, I would think, needs to be re-examined and hasn't worked very well for the market. Because these are dollar funds investing in Naira, local currency, and it's difficult for these funds to make money because they are taking a lot of exchange rate risk, and the companies they're investing in are earning Naira, not dollars. So at the end of the day, you find that even though you are making those dollar commitments to the private equity funds, your returns are challenged because they're essentially earning Naira. So there's a new way of thinking now around private equity that it has to be local currency, Naira funds. Also, maybe things around debt instruments rather than equity, and a co-investment approach with the pension funds. So what we're doing now, we're busy trying to see if we can set up a framework for a co-investment vehicle, which the pension funds can co-invest alongside private equity fund managers in dedicated opportunities. I think in private equity and in venture capital, there's a lot of interest in consumer names, consumer goods, and more importantly in fintech. Fintech is now becoming something of interest because they are disintermediating the traditional banks, and there've been some good investment made, that have made the headlines in Nigeria. Paystack, a company that was started in Nigeria, recently was acquired in a $200 million valuation. The company is 5 years old, and I know some people that invested in it, individuals. So we're seeing how pension funds can now get into that game. And of course, finally is infrastructure. There's a whole, I mean, it's a coincidence of interest between the pension funds looking for long-dated instruments and bonds that can be used to finance infrastructure, the big infrastructure deficit in Nigeria, and the government interested in channeling the pension funds into infrastructure. The government's budget is challenged, so they are not able to finance large-scale infrastructure anymore. So the government have decided to sponsor, alongside the Sovereign Wealth Fund, the Nigerian Infrastructure Investment Fund. The pension fund are really involved. I serve as a member of that committee, and it is a big push to get the pension funds invested. Currently, the pension funds have increased allocation to listed equities, but the listed equity space is thinning out. So there's also a big interest in getting exposure to unlisted names that might eventually get listed, not necessarily through private equity funds, but unlisted names, pre-IPO names, pre-IPO names that may get listed in the next 6 months or 1 year. So I think that in a way, the crisis has created an opportunity for pension funds to change the paradigm in the way they think, and then to begin to see themselves as long-term investors. And I think that diversification and multi-asset class approach is very important. Finally, it has challenged it has challenged the skills of the pension fund managers, because now that they need to know not just how to buy government bonds, but how to evaluate private equity, evaluate infrastructure, evaluate housing, and diversify away into foreign listed market. So it is bringing capacity to the market, and it's interesting because now you can attract some of the, maybe even some names or some Nigerians in diaspora who have experience in this area, and also build the capacity of the local players. Thank you.
Thank you. Thank you very much. Jackie, coming back to you, and wanted to discuss now, I mean, seeing this and how this environment is evolving and the different needs that are required, like we just talked, David just mentioned, like building of new skills and capacity and accessing long-term support to change regulations, etc. I was wondering if you could tell us what you think MDBs or DFIs in general what role they could play to support this industry in Africa going forward.
Well, the crisis has underscored the need to give greater priority going forward to increasing the level of longer-term domestic savings in African economies. Just to start with that sort of broader point. So if interest rates are low or inflation is high, there's a disincentive for people to save. High inflation will erode savings over time, and people don't want to tie up their money by holding financial instruments in that kind of context. So international financial institutions, I'm speaking broadly here, the DFIs, can help countries to put in place enabling conditions as a starting point that could lay the groundwork for developing local capital markets, including the buy-side pension markets. The sound and stable macroeconomic fundamentals that are prerequisite for developing a well-functioning local capital market. If interest rates are very high and short-term government securities are high yielding, we've all been talking about this really. There's no natural incentive for pension funds to diversify into other asset classes. So it's quite interesting, as we've mentioned on the panel, that now that interest rates are low, this may be giving somewhat of a push. We all know and understand that as a starting point for launching and developing a local capital market that can effectively intermediate longer term finance, that the basic ability for investors to predict, to have a sense that fundamentals are somewhat stable is essential. That's obviously markets in the region that are other than Kenya and Nigeria, which have these fundamentals in place and have fairly large pension industries. So my World Bank colleagues on the operational pension team provide advisory services to regulators, and they stand ready to provide support to client countries to devise emergency responses to the crisis, and also to help devise sustainable long-term reforms on the regulatory side. Policy actions adopted in response to the COVID crisis need to balance the urgent short-term needs and the longer-term implications of reduced contributions or faster access to pension rights or longer-term savings, as Nozomo outlined very well, which may have irreversible negative long-term impact. So the crisis also underscores the importance going forward to bolster and further grow local pension funds, contractual savings institutions in the region's economies by enabling more extensive participation. So coverage ratios remain relatively low. So with the informal sector making up as much as 95% of the private sectors in many of the economies, increasing pension coverage to informal sector workers is an important priority where feasible, to have more comprehensive participation. And here, financial literacy initiatives and at point of transaction for microfinance or even remittance service transactions may help actively promote a culture of savings, even among the very poor with limited means. So there's also significant further potential for interventions by DFIs that develop the role of local institutional investors as asset managers, of course, to help local pension funds and other investment managers with the longer term horizons to improve their capacity to manage savings across asset classes and invest in the longer term investment vehicles that could help develop the local capital market buy side. So the IFC and the World Bank work together to develop product on emerging local capital markets that would be attractive to pension funds and other local institutional investors. And I know, of course, the African Development Bank does a lot in this area with longer term investment horizons. And this can include interventions that assist in launching niche vehicles, debt and or equity funds that could channel longer term investment to infrastructure and other longer term uses that would advance socioeconomic development. For example, private equity, venture capital, infrastructure funds. Dave mentioned that being a big priority right now in Nigeria and Kenya, depending on local context and capacity, of course, beyond those two markets. So these vehicles could operate on a sub-regional or regional basis as well as a national basis. As mentioned, geographical diversification can help investors mitigate the risk as well as the clubbing together in some of these vehicles of multiple pension funds. So that's an overview. I could mention specific projects IFC's involved in, has been involved in, but I think I'll take up too much time. Thanks.
Thank you very much. Thank you very much, Jackie. We are almost now at the end of our session. I invite participants to submit their questions to the panelists if they have, if they want to clarify a certain point. Feel free to use the Q&A box at the bottom of the Zoom session. While you're doing that, Nzomo, I wanted to come back to you on the point actually of as in your position as also chair of the African Pension Supervisor Forum, can you tell us a little bit about what you like, to which level you think that now collaboration between country, exchanges of information, and then regional, I would say, collaboration, do you think it will play a bigger role now in the context of the post-COVID-19 economic recovery? And in your specific position, where do you see the forum role to play in the future?
Yes, thank you. Yes, we have come together as African pension supervisors to see how we can collaborate and work together in a number of areas. Whereas many of us are indeed members of international associations and so on, we do have unique challenges in Africa that we would want to give more emphasis to, including what Jacqueline has just been talking about, strengthening capacity of our schemes to invest in alternative assets, to understand some of these new products and so on. which might not be a challenge in other parts of the world. Also issues of coverage, coverage of pensions is very low in most African countries. But when you go to the developed world, coverage is almost 100%, so it's not such a big issue. So there are a number of issues which are really unique to Africa, and that we need to put more attention on. And this is one of the things that we are doing as African pension supervisors. When we have our meetings, like we recently had an annual meeting in September, we really were able to discuss a lot about those issues which of a lot of concern to us. And this enables us to share experiences. And so, for example, on the area of coverage, Rwanda has done an innovative product which is targeting the informal sector, which has picked up very well, and they've been able to, bring a lot of people on board the pension system, technology-based system. And many of us, other African countries, are really trying to borrow from that and do similar things in our jurisdictions. And other jurisdictions are also ahead in certain areas. For example, if you look at the area of ESG investing, we see South Africa is well ahead of most of us. So we're also trying to learn from what they have done so that we can also not reinvent the wheel, but adopt some of those good practices. So collaboration is key. But I would just like to touch on the previous issue of how DFIs can also assist us. On the supply side, if you look at Kenya, for example, we have very progressive investment guidelines which allow all kinds of exciting investments, REITs, corporate bonds, ETFs, derivatives. But these things are just not there in the market. So even if the schemes are ready and have the capacity to invest in these areas, on the capital market side, the supply is just not there. So, as we do this work, trying to build capacity of our schemes and so on, it's also critical for us to make sure on the supply side, the capital market development side, and so on, and that these products are available. Otherwise, you may have schemes ready to invest, but they simply can't. They can't get the products. But I'll just make that point.
Thank you very much, Nzomo. We received a few questions from the participants. Let me start with a question from Da, who is asking, how can pension funds support SME financing in Africa? Who wants to take this question? I think David Udwanu just apologized, but he had to log out now to go to another meeting. So perhaps, Nzomo, can I turn this question to you?
SME financing in Africa, maybe not directly, because the nature of schemes, of course, they don't do direct financing. But indirectly, schemes can contribute to this. For example, I mentioned private equity. Private equity is one of the areas which invest a lot in SMEs. Like here in Kenya, we have seen a lot of private equity funds that have done very good work with SMEs. So by pension schemes investing in those private equity funds, they are in effect supporting that market. Another new innovation that we have here is the government has launched a credit guarantee scheme for SMEs, and we expect them to come to the market perhaps with bonds and so on to raise funds for that scheme. So again, pension schemes can invest in those kind of products. So I think the role of pension would not be direct, but it would be through investing in various long-term asset classes that are targeting that area.
Thank you very much. Thank you very much. And another question from a participant is asking, like, increasingly pensioners are concerned with government accessing pension fund for investment. And what rules or engagement can be made to allay the fear of pensioners that investments are not forms of leakage and bridge the trust gap? Very interesting questions. Maybe again, Nzomo, if I can turn this question to you.
It's not only governments. Everybody wants to access pension funds for investment, because they know these are long-term funds and huge amounts and so on. And the critical thing, of course, is putting in place a very solid regulatory structure. For example, for us, even though we have investment guidelines which allow, let's say, investment in infrastructure, which governments would love pension schemes to invest in infrastructure. Before the pension scheme invests, it first has to have an investment policy, which it has done with some professionals, which allows that asset class. That would depend on its own, liability asset matching and so on. Number two, it must have a fund manager who will do the due diligence of that project. And if it's not a viable project, it is going to give the members good returns and safe and so on. They will not approve it and so on. So we have all these checks and balances. So as much as governments want to access these funds, they must come with viable projects which will deliver at the end of the day.
Thank you. There's a question from Nana Haibor, maybe to you, Jackie. What are some of the macroeconomic challenges with Africa, which African governments need to tackle to attract private capital and pension funds to invest in infrastructure? You're on mute, Jackie. Jackie, I think you are on mute.
Sorry, Olivier.
No problem.
Broadly speaking, of course, because this will vary significantly, I think, by economy. But the challenges there are providing a macroeconomic context as a starting point that's conducive for longer term savings, for channeling the longer term capital into infrastructure. As mentioned, if people won't want to put money aside in even basic savings accounts if they're not getting returns on it. So in a context where inflation is too high, doesn't make sense pragmatically to put money in savings accounts, just starting at that level. A high inflation environment is not conducive to saving. Low yield environments which we're facing now, I think, across the world, are not conducive to putting money in debt instruments, right? Which, of course, pay their returns based on a government benchmark yield curve, or the policy rates determine what those pay out. So a debt fund investing in infrastructure would have a hard time right now. Those are just a couple of examples.
Thank you very much. Last question from Daniel Okonji. I think that was addressed to Nzomo. Do you actively engage capital market operators to deepen the supply side?
For us, as regulators, of course, we engage our fellow regulators, to work together to bring on board products on the supply side as well. And we do participate a lot in their policy formulation and so on. Make sure that what they are doing is concurrent with what we are doing. So for us, we may not deal directly with the operators, but we will deal with the regulators, and of course, policy advice to the government.
Thank you. Thank you very much. We've been through, I think there's no more questions from the participants, and we are right on time for 1 hour. I really want to thank you so much, Nzomo, Jackie, and David, for taking the time to take part to this session and to share in such a detailed way and exciting way, like what is happening in your countries and region, and your perception and of the situation. It's as we've seen, there is a lot of challenges, but also a lot of opportunities that this crisis has forced us to look at how to do things differently. So I think this is something that definitely Making Finance Africa, the FDB, IFC, and the regional bodies such as the one you are chairing, Nzomo, will need to keep working together in the short and long term to see what we can do best to support the sector. And with that, I think I will perhaps hand over to you, Abdelkader, for the closing. Thank you all so much. Thank you very much. Thank you.
Thank you very much, Olivier. And we will, and thank you all also to the panelists for their insightful contribution. We will now go on break for 30 minutes, and then we'll resume at 1 p.m. my time at GMT for the last session of this AGA, which will be tackling the issue on gender and the role of gender-sensitive policy responses in the COVID recovery. So see you all shortly.